My name is Steve Moore. I work at Wayne State in the Mike Ilitch School of Business, and it's exciting to be here to introduce my friend Nancy Welber today. Nancy's an attorney in private practice, Nancy H. Welber, PC, in Farmington Hills. She is also a CPA. She received a Bachelor's of Business Administration and a law degree, both from University of Michigan. I thought that might get some chats. Yeah, good work, John. Nancy is a frequent lecturer to legal, accounting, business, university, investor groups on the topic of estate planning with retirement benefits. Nancy's had to intercept a few phone calls from me on that. She was a member for many years of our plan giving group at Wayne State. She's married to Richard Barr, also an attorney, environmental and economic development, and she has 2 daughters. In her spare time, which is not all that much, she enjoys doing volunteer work, biking, reading, and downhill skiing. We were trying to figure out at dinner last night when she said keep her intro very brief. It's probably been about 20 years that I've known Nancy. Her office is right up the street from a branch that we had in Bloomfield Hills. So obviously we both started in this business when we were in grade school. So please join me in welcoming Nancy Welber.
Thank you, Steve. Really appreciate that. And yes, we were both kids when we started. I just want to start actually with a survey. How many of you in this room are plan giving professionals, in other words, in the development part of the business? And how many of you are financial planners or lawyers? Okay. So what I think I'd like to do is I'm probably going to flip my program a little bit. I'm going to cover as much as I can of the whole thing, but I'm really going to try to zero in on the charitable giving aspects and some of the things that you might see if you are involved with charities. So we're going to probably go a little bit at the beginning, but then towards the end first. So name of my, you've noticed it's called Don't Try This at Home, Estate Planning and Retirement Plan Designation. In other words, it's really about beneficiary designations. And one of the hardest things that I have in my practice, and I do estate planning with retirement benefits, is really what I do, pardon me. I hope I don't need those. And that is trying to convince my clients that, thank you, that they should pay me to do their beneficiary designations. Why should they pay you? Why should I pay you to do a form? There they go. To do a form that, I don't know how that happened, to do a form that I can do for free. Why should I do that? Well, when my friends who are other attorneys call me and ask me to consult with them about the disasters that their clients have created, tax disasters, that's where the value comes in. And so that's why it's called Don't Try This at Home. This is sort of based from a Bar Journal article that I did for the Michigan Bar Journal a couple of years ago with that title, which is, it seems so simple to designate a beneficiary of an IRA. Just write the names down or write the charities down. But bad things can happen if you don't know what they're doing, because the regulations are so onerous and have so many traps for the unwary that you really have to be careful in advising your client. And by the way, Ray is exactly right when he was talking about targets, arrows and targets. For many of my clients, I have clients where the beneficiary designation is their main estate planning document, because they could have a house and they could have, let's say I have, a lot of my clients are college professors. So they may have a lot of money in, say, TIAA, and then they have a very small amount, relatively speaking, in bank accounts and other after-tax investments. And it's the elephant in the room. And you wouldn't fill in a blank just, for anything else, but it seems like you wouldn't fill in a blank to do your will or trust. I mean, some people do, they do LegalZoom, but at that point, they probably aren't doing LegalZoom if they're coming to someone like me, but they would do it for the beneficiary designation, not realizing that that is the arrow and the target is the beneficiary. And getting the right beneficiary is just key in this area if you want to avoid an acceleration of the retirement benefits. So that's sort of where we start. Now, what I wanted to do is take you sort of briefly through the minimum distribution rules, because this is, there's a wonderful woman by the name of Natalie Choate. Show of hands, how many of you recognize her name? Okay, so Natalie Choate is a Harvard-educated undergrad and in law school, brilliant and very funny woman who literally makes a living out of one code subsection, which is 401A9. And those are the minimum distribution rules. And she has a book, which is the Bible, about this topic. And really, this is what she does all year, is go around and does lectures and things like that. So the point is that that's how that you can write a whole book about one code subsection. Just tells you how difficult this area is and how much attention to detail you need. So let's quickly start with the minimum distribution rules for an account owner. You probably all know that people have to start taking their minimum distributions, at least from a traditional IRA, at 70.5, actually the year that they attained 70.5, or by the April 1st following that year. But there's certain exceptions. If you're still working and you're in a qualified plan and you're not a 5% owner, then you're able to defer that till you actually retire. And in a Roth IRA, you have retirement immortality. You never have to take a distribution if it's your own account. The other bonus that the account owners get is they get to use what's called the Uniform Lifetime Table. And that Uniform Lifetime Table assumes that you have a beneficiary who's 10 years younger than you. And you might say, well, why did they do that? Well, it's a long story, but basically the system that they had before 2001 or 2002, when they finalized the regulations, was so complicated that they basically couldn't audit it, in my humble opinion. So they had to come up with this scheme, which was based on some other regulations. So you get someone who's 10 years younger than you, no matter who it is, and even if you have a charity as your beneficiary, you get to use this table. The only exception, if your spouse is actually more than 10 years younger than you are, in that case, you get to use the spouse's actual life expectancy, which is more beneficial. Very important to understand that in the regulations, there is a hierarchy of beneficiaries. The spouse, who is most favored beneficiary status, other individuals, trusts, which are kind of a hybrid situation, charities, and typically estates and other entities. And estates are usually, estates status do get moved up if the spouse is the only beneficiary and is the personal representative. But basically, naming an estate is almost always a bad idea. So some of the basics, and this is all, again, naming the beneficiary. So what we're usually looking for is a designated beneficiary. And you might say, okay, well, you just told me that, I've got a charity. A charity per se will never be a designated beneficiary. And why do I care about that? It's very important because you may have individuals that you are sharing these retirement benefits with, and it could be very important not only to get the charitable deductions for you, but also to the extent that the individuals are taking to get them a stretch out over the longest possible life expectancy that they can use for their benefits. So as a consequence of that, you have to make sure that you kind of understand these rules or know who to ask to make sure you're not violating them. So I'm going to go through them, I hope, relatively quickly so that we can talk more about the charities. So when you have a designated beneficiary, the code for that is human being, okay? got to find human beings that are going to take to have a designated beneficiary. And that is one or more individuals, or what we call a see-through trust, which I'll talk about later. If the account has one individual beneficiary, then that beneficiary is a designated beneficiary. And if you have multiple beneficiaries and they're all individuals, then there's one or there's more designated beneficiaries. It gets complicated. When do you determine the identity of the designated beneficiary, or more accurately, if you have a designated beneficiary? It's determined on September 30th of the year following the year of the account owner's death. So that means if someone dies in 2016, we determine whether there's a designated beneficiary on September 30th, 2017, okay? Why do they do that? It gives us time to actually sort of fix the designation if there are undesirable beneficiaries in the mix. Sure. So what I call the beneficiary determination date, or Natalie Chug calls the beneficiary finalization date, is September 30th of the year following the year that the decedent died, the account owner died. So somebody who dies in 2016, whether it's January 1st or December 31st, they either have a year and 9 months or they have 9 months to figure out the beneficiaries. And if you think that you have a long time, I will tell you a story at the end which will tell you that it can be a race against the clock. So it's important to be very cognizant of that. And there are other dates that coincide with December 31st of the year following the year of death. So it's very convoluted. And the other thing that you have to understand is there's not a lot of logic to these rules. It's frustrating, and the reason that I know them so well is I've actually been working with the rules since 1988, when the first set of proposed regulations came out. So, yeah, I'm older than I look. Yes, I've been working with them for a really long time. So it's just that I've learned these arbitrary rules. I know how they work, kind of, sort of, because the IRS holds all the cards, and sometimes they have surprises for us. So essentially, what you need to find out for non-spouse beneficiaries is the applicable distribution period. How long is that stretch going to be? And I'm not going to go into great detail on this, because suffice to say, for your purposes, the stretch is different depending on whether someone dies before their required beginning date, before the year that they attain age 70 and a half, actually the April 1st following the year that they attain age 70 and a half, or whether they die on or after their required beginning date. So it's really that April 1st deadline. Oh, and by the way, if you have someone in a qualified plan that's over 70 and a half and they haven't retired and they die while they're still working, they have not reached their required beginning date. So that's, there are a lot of subtle rules here that you have to understand. And that's, the other issue is, remember Roth IRAs? Roth IRAs don't have any minimum distribution rules. You probably won't be seeing any, if you own the Roth IRA, you probably won't see a lot of Roth IRAs being given to you as if you're in the development side, because there's no tax benefit to doing that. So normally you wouldn't see that, but it's important to know that the account owner always dies before the required beginning date with a Roth IRA. Why? Because there's no minimum distribution requirement. So essentially what happens is, if you've got a beneficiary who, the beneficiary's life expectancy is always going to be in the mix if you have a designated beneficiary. Someone dies before their required beginning date, you just use the beneficiary's life expectancy, which seems easy until you get to multiple beneficiaries. If you die after the required beginning date, you actually get the longer of the life expectancy of the account owner, decedent, or the beneficiary. Now, most of the time, the beneficiary will be younger than the account owner, but not always. You may have spouses who are fairly close in age, and unfortunately the younger spouse dies first, but past the required beginning date, then you get to use the spouse's life expectancy and the decedent's life expectancy in that case, or sister-brother combinations, things like that. Okay. Again, now we get a little more complicated. If you have multiple beneficiaries, what do you do? Well, it depends. Nice legal answer to that question, right? So if you have multiple beneficiaries, there's a couple things that happen. One is, essentially, at the very beginning, you're all in this together, and you're going to see, first of all, do you only have individuals? If you only have individuals and they're named directly in the beneficiary designation. So my beneficiary designation says, let's do it this way. I leave it in equal shares to my husband and my 2 daughters. Outright. Okay. What does that mean? Well, at first blush, if we looked at that September 30th deadline, we would say, well, they're going to use the oldest beneficiary's life expectancy. Okay, so they'd use my husband's life expectancy to determine minimum distributions. But there's another rule with multiple beneficiaries, which is if I can create separate accounts, we're going to use IRAs for the most part, separate accounts for them by December 31st of the year following the year of death, then I am going to be able to use each person's separate life expectancy. Okay? So now we don't just have to use my husband's life expectancy, but each of my 2 daughters gets to use their own life expectancy. So my younger daughter is not, does not have a disadvantage in that situation. Sometimes you also have to take the first required minimum distribution at that point. When someone dies, the minimum distributions, and this isn't in the materials, but you may all be kind of familiar with the idea that when you die, the year of death, if the account owner is already taking minimum distributions, you have to take out the rest of the account owner's minimum distribution for that year based on their life expectancy using the uniform lifetime table, or if it was a spouse more than 10 years younger, that factor, okay? It's not until the following year, the year following the year of death, that you take minimum distributions based on the life expectancy of the beneficiary or beneficiaries, okay? So that's what you're going to do, is on the second year, you're going to use it based on the beneficiary's life. And what are you going to do? You're going to see if by the end of that year you have separate inherited IRA accounts, or if it's a spouse, a rollover account, and spouses have separate special rules. Basically what you're going to do is you're going to figure out each person's life applicable distribution period based on the life expectancy factor from the single lifetime table, and take a minimum distribution by that December 31st deadline. By the way, you don't want to miss the deadline, because the tax, if you miss it, is 50% of what you should have taken. Not 15, it's 50%. Now, having said that, if you have reasonable cause, the IRS, you will send in the form, put a little RC next to a certain line, and ask them, please, IRS, be kind to us and waive this. And you better have a good story, but they usually will waive it for you. And I'm hoping that's the case, because I just sent one in for someone who didn't do it for 29 years on an inherited account. It's a long story, but anyway. Okay, so that's sort of the basics. So you take this distribution in that year. In some situations, and it would be rare, you could have a problem where you've got to take that out by if you don't take that minimum distribution, you could end up with the 5-year rule, which means the account has to be distributed within 5 years. When would that happen? 2 situations. One is there's now a charity in the mix, and it doesn't get out of the mix probably by September 30th, possibly December 31st. In theory, December 31st is the magic day. I would not encourage you to leave your interests in past September 30th if you've got to please your non-charitable beneficiaries, the individual beneficiaries, and get a stretch out. I don't know of any private letter rulings where the charities stayed in after September 30th and they got their money out before December 31st, and that was okay. And I don't want to be the test case if I can avoid it. So you could end up with the 5-year rule if you don't take the first minimum distribution in that case. The other situation is if you are getting money from a qualified plan, you can now do a rollover from a qualified plan to an inherited IRA if you're an individual, but not a charity. So it becomes a real problem. Again, the individuals have to take their first minimum distribution if the 5-year rule would apply. In other words, someone dies before their required beginning date. If the 5-year rule would apply, the individual has to take their money out, their first minimum distribution, I should say, by that December 31st deadline, or they're going to get into the 5-year rule. So a lot of technicality here, but that's how it works. So again, you have to realize different rules whether you're dealing with a qualified plan or an IRA. So that's a big takeaway. So if you see a qualified plan, you need to understand that you potentially have different rules and different ramifications than if you have than if you have an IRA. And so what happens if let's say you have 3 kids and they don't get their act together and they don't take the first distribution in time and we're not dealing with the 5-year rule, what happens? Well, then they're just stuck with the oldest beneficiary's life expectancy. And they can create separate accounts later so that they can have separate investments, but they're going to be stuck with the oldest beneficiary's life expectancy. Now, if you have 3 kids born within, let's say, 4 years of each other, not such a big deal. But if there's a big age disparity, then it makes a big difference. This usually comes into play more with trusts, and that's where it gets really complicated. So children and grandchildren make great beneficiaries because they're young, and they can stretch to like age 83. What's also important to know is when you do have individuals, and they're the primary beneficiaries, they get to stretch only, that's fine, they get their stretch to age 83, but if they die prior to that, they can name successor beneficiaries. They only get to continue that stretch. They don't get to start over. So in other words, if they die when they're 75, then the successor beneficiary is going to get 8 more years of stretch. And so that's important to know. If you don't have a designated beneficiary, so that's where you come in, then if somebody dies before the required beginning date, the assets or the retirement assets have to come out of the IRA or plan within 5 years. The December 30th of the 5th year following the year of death. So if somebody dies in 2016, then by the end of 2021, you have to completely cash out the IRA. It can be done, in whatever proportions you want over those 5 years, but or it's really 6 years in some cases. If they die towards the beginning of the year, you'll really have 6 years, but 6 tax years. So, but it has to be done by the end of the 5th year. If, however, somebody dies after the required beginning date and there's a charity in the mix, much better result in a lot of cases because you get the account owner's remaining life expectancy. Okay, so think about that. Account owner has died and they have a remaining life expectancy. Only the IRS could come up with this idea, okay? Again, some measure of immortality. So essentially what we do is we look at how old the account owner was or would have been on their birthday in the year that they died, and they say, okay, we'll go to the tables and we'll see how many more years there are left until they would have run out of distributions on a declining balance basis, and you get to use that. What's incredible is there's a huge difference. There's like about an 8-year swing. If someone's 70 and has died before their required beginning date, so they're not 70 and a half, they haven't hit that April 1st date, and someone who dies just after that April 1st date, amazing difference, like an 8-year difference. It's huge. So proper beneficiary designations are really important. Now, what if all you have are charities as beneficiaries? Who cares? You guys are going to say, show me the money. You don't care. There are times when it doesn't matter if you have a designated beneficiary or not. Because honestly, if you've got a spouse and a charity together, the spouse can roll over anyway, and the charity's going to take their money right away. So sometimes it's not a big deal, but in a trust, it can be a huge deal. So spouses as beneficiaries. I'm going to go through this, but I'm going to go through this more slowly because really it doesn't make that much difference to what you deal with on a daily basis. I think you all know that the spouse is most favored and they have a little bit more that they can do. They can roll over. They can do inherited IRAs if they're young and they don't want to get a 10% tax on early distributions. They can do inherited IRAs if they happen to be older than than their spouse who died, and they could actually defer until the spouse would have been 70 and a half. So there's techniques in here that might be interesting to you so that you can sound really smart and really save your clients some money, in the interim while you're doing their planning. And then, the hook is then you want them to leave some of their IRA to you. So again, and the spouse gets to use the uniform lifetime table when they're figuring out distributions. A non-spouse beneficiary has to use a single life table. It's a big difference. So I just sort of glossed over the spouse's inherited IRA for the surviving spouse and the rollover. Now I'm going to turn to trusts. And these are not charitable remainder trusts or lead trusts. These are just your client's revocable trusts, because whether it's in an IRA trust or whether it's in a revocable living trust, there are very specific rules on how to name trusts as beneficiaries, and this is where it gets really dicey when you have a charity in the mix. And I'm going to try to talk about that for a little while, and I'm not going to go through a lot of the stuff with trusts, but it seems really easy on its face to have a trust as the beneficiary because there's 4 rules. The trust has to be a valid trust under state law. That's really pretty easy. It has to be irrevocable on the date of the account owner's death or become irrevocable. Again, easy. All the revocable trusts, account owner dies. Usually it's going to be irrevocable unless you have a joint trust. But as long as the joint trust is with the spouse and the spouse has the ability to just take all the money out of it and roll it over, that's not going to be a problem. We now have private letter rulings that say that. You have to provide, the trustee has to provide the IRA custodian or plan administrator with a copy of the trust and any amendments or a list of, and I don't even put the list in here, I don't think, because honestly, nobody gives the list unless the custodian requires it, because you could make a mistake. It's not worth it. It's a lot of work. You just hand over the trust and any amendments by October 31st of the year following the year of death. And all trust beneficiaries have to be identifiable. Aha, sounds easy. Again, code, human being. It's a lot easier than it sounds. And I could spend 2 hours at least just talking about bullet point number 4. And commonly, a trust that meets all of these rules is called either a see-through trust or a look-through trust, usually a see-through trust. You will find that nowhere in the code or regs. It's just something that has become colloquially how we refer to these trusts that meet these 4 rules. Not as easy as it looks. So again, what's really important with trusts, and I'll leave the fine print for later, is basically that the beneficiary designation is the major estate planning document for many of the clients. And the beneficiary designation really needs to target where those benefits go. So if I have $1 million IRA, which is pretty common in my practice, you know, I may want to split it between trusts and a charity. And if I really want to get the best tax benefit for my clients, the way that I'm going to do that is I'm going to name the charities in the beneficiary designation directly. And if I need to get it into the trust, then I'm going to name not just the trust itself usually, but the subtrusts that I create. So those trusts for my children, I'm going to name the specific trust for my children. No, it doesn't have to say the Jessica Trust or the Rachel Trust. It can say the individual trust for my children in the beneficiary designation, but it's really clear that each beneficiary has their own trust. It's very important. The other thing is, what if I do have a trust? What if it is payable to my revocable living trust? And in that trust, we have charities and we have individuals. This is my nightmare scenario in lots of cases, and I will tell you about that later. But let's say I'm giving $10,000 to the University of Michigan. As long as that $10,000 comes out of any asset, including the retirement accounts, by that September 30th deadline, then that's fine, and I'm going to be able to have a see-through trust, okay? So I pull $10,000 out of the IRA that's payable to my trust. I give it to University of Michigan, you know, on January 1st of the year following the year of death. Not a problem, okay? Because the charity is completely cashed out and they're out of there, not a problem. Where you end up having problems is, and I'm going to defer this a little bit, is where the charity is a percentage beneficiary, or even more difficult, where the charity is a remainder beneficiary. So what you want to make sure is that your clients aren't just automatically naming the trust as their beneficiary. You know, estate planners will give your client, you know, will say to your clients, oh, your trust should be the beneficiary of, you know, just name your trust. Well, that's a really bad planning strategy for your retirement benefits and also your after-tax annuities that you buy, because the income tax ramifications can actually be a complete disaster. And there's even, and if, let's say, rather than having the money in an IRA, let's say they have it in a qualified plan at a big company. You may not even get the 5-year rule in that case. You may get an immediate distribution of all of the income from that plan into the retirement account. Why? Into the trust from the retirement account. Why is that? Because the minimum distribution rules just tell you what the minimum amount that has to come out every year, but it doesn't say it can't be faster. So very typically, if you see profit sharing plan or saving plan, there's a really good chance, you want to see those plan documents, there's a really good chance that if you have a non-spouse beneficiary in particular, that the distributions have to come out in a lump sum. So you have to know that they need to do a non-spouse beneficiary rollover if they possibly can to get the stretch. And if they don't do that and it comes out in a lump sum, it's a big tax bill to pay. Now, if it's, you know, a very small amount, $20,000, $30,000, the kids might cash it out anyway, who cares? But if we have a lot more zeros after that, it can be a really profound error to put that into a trust. So you really have to know what that means. Remember I alluded to the idea that if I pay U of M off with their $10,000 by September 30th, I'm not going to have a problem. Okay, so what we're looking for, again, are identifiable beneficiaries in a trust. And what you have to do is really look at the whole trust document to figure that out. Sometimes I have clients that will name their IRA as beneficiary, the beneficiary is their trust, and they name their 3 kids as the beneficiaries. Well, what happens then? I have multiple beneficiaries. They're all going to just take it outright. Isn't that the same as the beneficiary designation, naming them? It is not. If you name them in the beneficiary designation, then you can do this December 31st thing, and by December 31st of the year following year of death, you have separate accounts. They each take, they have their separate accounts. They take their minimum distribution. They use their own life expectancy. Not so in a trust. In a trust, it's very different. In that case, what you have to do is you have to use the oldest beneficiary's life expectancy. So, and this follows through all the way down. So what you're going to have to do is really look at you look for not the oldest beneficiary, but the beneficiary with the shortest life expectancy. And if you're a charity, that's you, because your life expectancy is 0. And that's why it's very important. So to be able to be a see-through trust at that September 30th date, if there are other beneficiaries that are individuals in that trust. If they're only charities, we don't care. It doesn't matter. So you want to make sure that the charities are cashed out. There's ways to get the money out by that time. And if they can be, then the individual beneficiaries aren't going to have a problem. One of the issues is sometimes you have trusts, let's say it's a single dad for whatever reason, divorce, leaves the money in trust for the 3 kids, they get all the income for life, they get distributions for health support, maintenance, education, and they get a third at 25, half at 30, half at 35. Okay, pretty typical estate planning. What you're going to find is that's called an accumulation trust, because the trustee doesn't have to pay out any portion of that distribution to the beneficiary necessarily. And why is that important? It's very important because it helps you to figure out whether you actually have a designated beneficiary. By the way, remember, this isn't logical. Just a reminder here. So even though the kids will get the money by age 35, the IRS doesn't care about actuarial reality. They're in a separate reality. So basically what you have to do is you have to look at that trust and say, okay, so the trustee in that situation must take out from the IRA the minimum distribution each year. But they don't necessarily have to distribute that whole thing. And what that means is somewhere down that trust, they can then there's going to be a remainder beneficiary who could potentially receive a penny of that IRA if that beneficiary doesn't live to their full life expectancy. And as long as that beneficiary hasn't reached the magic age of 35, even though actuarially they're 12 years old, they're going to make it, the IRS doesn't care. So now you have to look at the remainder beneficiaries. And let's say they're young kids and they don't have kids. Now you're looking at your disaster distribution. And, if your charity is in the disaster distribution, you are going to cause that trust to fail as a see-through trust. And what can you do in that situation? Well, you're going to work with a good estate planner, and the estate planner is going to say to you, we have a really big favor to ask of you, which is, we've got 3 kids, and if one of them, and it will first go to their children if they survive and have children, but they don't survive to 35. And if that doesn't happen, it's going to go to their siblings. And if that doesn't happen, it's going to go to their kids. And the chances that you are going to receive anything is going to be really remote. So will you please disclaim your interest in the remainder? Because that way we might be able to get see-through trust status if we can figure out that we've got, perhaps under the intestacy laws, maybe we can get a better remainder beneficiary. It may not be great for the kids because that remainder beneficiary who takes might be, you know, my husband or my sister or whatever who's a lot older than those kids, but it's better than a 5-year rule or a cash out. So it's very critical to do good drafting. So when I have that situation where I know my clients would like to give to charity, in that situation, they only get the non-retirement assets and the remainder is the remainder. Sorry about that, but in that context, I can't risk my kids not getting a good stretch out. They're supposed to be able, this is supposed to provide for them, and you know, if they're 40, they're going to have 43 years of stretch. If they're 10, they're going to have 73 years. And 73 is a lot better than 5. So it's really important. There's something else called, though, a conduit trust. And the conduit trust says, if I name a specific subtrust in my beneficiary designation, and it says, take all the required distributions out every year, and if you are allowed to, you can take more out. You can take, you know, anything that's discretionary or for health support, maintenance, education, whatever the standards say, take more out. But you have to use it for that beneficiary or distribute it to that beneficiary every year. And if you do that, then we don't care that the University of Michigan or the Jewish Federation are the remainder beneficiaries. Why? Because in that case, they say, oh, well, if they live to their actuarial life expectancy, oh, now they actually care about it. If they live to their actuarial life expectancy, they'll get every penny from that IRA. And so we don't care who takes afterwards. Well, what happens when they turn 35? Fine, you can distribute the IRA in kind to them as an inherited IRA, and they can continue the stretch. But these are the problems that come up when you draft and you have charities in the mix. It's really important. And you need to understand that so you can work with the planners who are going to tell you this stuff. So that's why I've got all this gobbledygook in here. There's other problems that come along with identifiable beneficiaries. And I'm not even going to bother going over them because really they're for the attorneys that have to deal with them. Okay, so now the main event, the charities. You guys are great places to park retirement benefits, okay? And, you know, if you've got a taxable estate, I don't have to tell you, you save estate taxes, you get income tax savings, and of course you want to use IRAs or traditional IRAs or employer plans, not Roth IRAs or actually, if you have a, I don't know why I left off Roth 401k since I have one, but you know, a Roth 401k, no one should be leaving a Roth account to you. They've already paid taxes on it. It makes absolutely no sense, okay, because that's a tax-free distribution, but unless they have no individual beneficiaries. But basically, you should be looking at traditional IRAs and employer retirement accounts. As I've already said, it's so much better if the charities are named directly in the IRA beneficiary designation. Now, what if somebody has a huge number of charities that they want to benefit? It should only happen, right? And they have a lot of money too. Again, there's one of my friends has suggested, and this was in Trust and Estates a couple years ago, to have a trust that would be an IRA trust for the benefit only of charities. And then you only have charities. All of the income obviously has to go to those charities, so you don't have a problem with an income tax charitable deduction. In theory, the trustee can then pull all the money out into that trust and then distribute it to the charities, get the charitable deduction, and you're good to go. The only issue with that is that somebody has raised the issue that maybe it's a private foundation, but it's really transitory, so I'm not sure that it really is. That's the only negative I've heard about it. I think on balance, it's a really good idea if you have a lot of charities. If you have 3, you can probably herd the cats, so it's probably not a problem. So you can still do individual beneficiaries and charities together, but again, you've got to meet that. I would suggest that instead of meeting the December 31st deadline, the charities need to get out of there by September 30th. And I know it won't be hard to twist your arms, but it can be difficult. Because you don't want to be the bad guys that mess up their stretch, okay? So that's really important. The other thing that I suggest is if there are a lot of charities to benefit, I do like to try to get my clients to take a sizable IRA and just make it into a separate IRA for charities. And if they say, well, I only want to give X dollars, so they can manage that by taking their minimum distributions from different pots. Because with an IRA, you can have multiple IRAs, and you're allowed to take your required minimum distribution, you the account owner, you can't put inherited IRAs into this mix, not Roth IRAs, which you don't have minimum distributions, and not other qualified plans. But if you have several IRAs, you add up what your minimum distributions would be from all of them. And in the aggregate, you can take it proportionately from each one. You can take it all from one. You could do it however you want. So what I suggest in that case is split it into 2, and then have one that's just for the charities. And then you don't have a problem with the identifiable beneficiary in September 30th deadline. You just want to get it out to the charities on a timely basis, and then you do the other, and the planner does the other planning with the individuals, and that's optimal. Can't always get that to happen, so you guys really need to play ball and make sure that you get your money out by September 30th. The other thing is, if the account owner is past the required beginning date and the individual beneficiaries are really close in age to the account owner, it might not matter. Because in that case, if it's a brother-sister kind of thing, it may be irrelevant. In fact, especially irrelevant if the account owner is older than them, is younger than them. In that case, you're going to use that life expectancy, so it's a lot better. Okay, so I've already said avoid the trust. So just to reiterate, so leaving the sum to the charity, you could end up, I've already said that, accelerating the income. And the other thing that can happen, and there's a private letter ruling on this by someone, and the person who got it is a pretty well-known accountant who does this kind of work, Bob Keebler, where there were charities that got pecuniary gifts, in other words, stated sums, and they used the IRA to fund they wanted to say, okay, we're going to give the charities shares of the IRA to satisfy these gifts. And it turned out that it accelerated that income into the trust because it was in satisfaction of that gift. And the charities didn't, and there was no charitable contribution deduction because the governing instrument didn't say that you pay the income to the charities. It just said the charities get a pecuniary sum, which is deemed to come out of, principal. That's a really big problem. So you've really got to work with someone who understands these rules. And again, the complete cash out. I've also provided you with a way to make a gift, and you'll see the last line about the no obligation. You will endear yourselves to every IRA custodian and plan administrator if you put that line in there, especially if you've got a specific fund that it's going to or a specific purpose. So, great gift, qualified charitable distributions. I'm sure you're all aware of them. Up to $100,000 can come through these qualified charitable contributions, which were just made, as I call it, indefinite, not permanent. I don't believe in any permanency in the tax law. But remember, IRAs only, and only someone who's over age 70 and a half. So unlike your first distribution calendar year, when you turn age 70 and a half and you could take your minimum distribution, you actually have to be age 70 and a half, which is a really big drafting error in my estimation. Not that they were willing to fix it, but if you're born after June 30th in a given year, you're going to have to wait till the following year. And if you're born in June, you can pretty much give it up, because good luck getting that contribution to roll over in time if you can't do the trigger until sometime in June. You may be able to do it if you're, June 4th or like today or something, but if you're born in late June and you can't pull the trigger until late in December, you may run into the cutoff for the year end to do that distribution. Again, it's a direct rollover. If you touch it, you're in trouble. And the bonus is it's not included in income, and it counts towards the required minimum distribution. So it's incredible. It's very powerful. The only thing that's better than that is using appreciated securities. So if it's a choice between doing the rollover and using appreciated securities, it's great if somebody wants to give you their required distribution, but after that, go with the appreciated securities. That's actually a better tax deal. And again, $100,000 limit. Two bills that are floating around. One was mentioned earlier, Senate Bill 2750, the proposal to allow qualified charitable distributions to donor-advised funds of up to $100,000. And I'm not sure if this was mentioned, HR 5171 that came out last week or the week before. Proposal to allow qualified charitable distributions to CRATs, CRUTs, and gift annuities. That would be up to $400,000. Limited time offer only through 2020, and special rules apply. So, but who knows if that'll get passed? Hard to say. The best news about what we have now is it's not going to sunset. So at least you know what you can do. Obviously, if they're proposing legislation to use donor-advised funds, you can't use them now. And if the client's under 70 and a half, it doesn't mean they can't give money to charity out of their IRA. They take it into income and they get an income tax deduction the old-fashioned way. But this is just really powerful if you've got clients who are wealthier and don't need their required distributions. So now, these are my concluding recommendations, but I have a couple minutes. So let me tell you about the case study I'm presenting next week with someone from Fidelity Investments in Boston. I had a couple of cases going at the same time where the trust was the beneficiary along with a big chunk going to charity and also to human being beneficiaries. And the one that I'm doing the case study on was 50% of the entire trust went to the sister, 50% went to 7 charities. Oh, by the way, 3/4 of what was in there was in the sister's corporate plan, single person plan. So what we had to do, I looked at that and I said, oh, we have a really big problem, because I can't make this work under the very complicated separate share rules and the allocation of income rules. If I take the money if I take distribution out of the IRA and want to distribute it to the charities, I can't do that. Under the tax law, I'd have to give half of everything to the sister. I'd get a charitable contribution deduction for the other half, but she's going to have to take that into income right away. Whatever they get, she's going to get right away. And that's really not good. We can't, and they're supposed to get outright distributions. That's not going to work for us, because under certain rules, I have to allocate it evenly among all the beneficiaries. I don't get to pick and choose in that case. So the problem is, what am I going to do? So what I said was, okay, I've got to have it so it never hits the trust. I have to do this all by creating shares in the plan so that at the end of the day, the charities will take their shares from the plan, and then after September 30th, the only one left standing in the plan will be the sister, and then she can do a charitable a non-spouse beneficiary rollover to an inherited IRA. Well, it sounds easy. Her sister died in April of 2014. So we had till September 30th of 2016. Sounds easy enough. Well, in this case, it wasn't. We had everything at a different mutual fund company, and getting information was really difficult. And understanding what we wanted to do with this plan was beyond their pay grade. Oh, and by the way, the plan had to go through a program to rehabilitate it because it wasn't actually qualified at the time. Oh, and by the way, they hadn't filed 5500s for like 15 years. So it was the nightmare scenario. The good news is I work with people who can help me with that. But the problem is then I had to get it rehabilitated. Once I got it rehabilitated, then I could move it to Fidelity. I happen to know people at Fidelity, so therefore I get like the crack team at Fidelity. So it's sometimes not what you know, but who you know. And basically what happened was we moved the plan intact from the other company to Fidelity. Now it was an inherited plan at Fidelity. Then what we had to do was 8 sets of paperwork for the individual and the charities. And I don't know how many of you have been involved in doing inherited IRAs, but it's a lot of paperwork, and it's more than for an individual. Because not only do you have to open the account, you have to do corporate resolutions. And at Fidelity, you have to have 2 different signatures on the corporate resolutions. And you have to give the, whatever they call the Patriot Act now information. And I had one charity that didn't want to play ball with us on that, so they had to do it a different way. It delayed us a week, which turned out to be extremely critical. So by the time I was able to actually fund their shares from the single inherited plan into the 8 shares, it was the end of August. And what I found out was there are residuals in this account. And by the time they were going to get their money out, it was going to come out in September. Remember, my deadline, September 30th. So I was dealing with the top person in the inheritor services group to be able to say, okay, when do they pay those residuals? Oh, in the beginning of October. I said, they can't. They had letters of instructions that said it has to be out of there by September 30th. The charities have to be cashed out. So we did this. I mean, so we found out that the one mutual fund only paid dividends once a year, or paid, capital gain distributions once a year in December, and that was it, and it wasn't going to be a problem. But their money market fund paid obviously monthly, so we had to get them to write special checks to the beneficiaries. Oh, but it gets worse, because the two of the charities took by wire transfer, and they couldn't do it by wire to get them their 28 cents that they each needed in interest. And so literally they mailed them checks on September 29th. And I'm still like gagging and thinking about what a close call it was. And as far as they were concerned, they had a 0 balance, they were out of there, and we were done. But I'm telling you, I had nightmares. Oh, and they couldn't use FedEx either. It was too late. So, we had to just go with it and hope for the best. Of course, I have this December 30th rule. They had separate accounts, so I might be okay anyway, but I don't want to rely on that. So when the lawyer shows up at your door, do me a favor and fill out those forms really quickly, because it really, that 56 cents was worth about $125,000 to the sister, because if they didn't, if they hadn't been a see-through trust, instead of getting 13 years of distribution in this particular case, the very best she could have gotten was 5 years, and it might have actually been, well, in her case, it would have been 5 years because it was a single-person plan that wasn't as draconian. But it really, you know, would have been a horrible, horrible outcome. She would have lost 8 years of distributions and would have had a much higher tax rate. So basically, don't try this at home. Make sure that your client gets really good counseling on the beneficiary designations. It's the arrow. They've got to know what the target is. Get someone who knows how to draft these designations. Don't be afraid to ask, if you're talking to someone and they're not sure about their attorney, do they know someone who, do they do this all the time? If they don't, mistakes can be made. I consult all the time with attorneys who don't want to be responsible for doing the beneficiary designations. I will do them for them. It's not for free, but I'll do that for them. And they have to understand that paying a little bit more to get the beneficiary designation done could save literally hundreds of thousands of dollars in taxes, and it's really important. So with that, we end. I think I'm a little bit over, but I'll be happy to